Section 5-4, we're going to talk about the concepts of petty cash. So you will establish a petty cash fund, you'll prepare a petty cash report, and then replenish that same petty cash fund. So petty cash is an account that is used for making small cash payments. So small cash payments. So let's say you wanted to buy stamps or something small that's just easier to use cash. That is what we had the petty cash account for. Petty cash is an asset with a normal debit balance. So it's just like cash. Increases with a debit, decreases with a credit. So petty cash is an asset with a normal debit balance. So when we establish a petty cash fund, the first thing that you're going to do is write a check. So we are going to write a check for $100, check number 8. We're going to take that to the bank, cash it in small bills, and put it in some sort of either money bag, safe, or cash register to use somewhere that's safe to use for our small purchases. So the first thing you do to establish a petty cash report is write a check. So it'll increase the petty cash account by 100, and it'll decrease cash since we wrote a check. So that transaction will look like writing the date, the title, which is petty cash. We're going to debit that because it's an asset that increases with the debit. Credit cash because we're going to credit cash and lower the value of cash by $100. And then finally, our source document is a check. This is the one and only time that you will ever use the account petty cash. The one time. We've used it one time. We wrote a check for $100 to fill that money bag with $100 cash for small purchases. That's the one time that you will use that account. At the end of every month, you're going to go through these petty cash slips. So every time we use petty cash, we are going to fill out a petty cash slip, starting with the date, then who we paid it to and what it was for, and the account that it would have gone in. Instead of filling out a transaction in the journal for a $14 expense, going and writing a check, it was much easier for Michael Delgado to just give $14 to the newspaper for the ad, and then we'll deal with the transaction later. So we use that petty cash account for $14, filled out this petty cash slip quick, and then we had $14 for our newspaper ad. At the end of every month, we will do something called a petty cash report. So this is where we'll take all of those petty cash slips that we had in our previous slide. We go through all those petty cash slips and organize them into a petty cash report. So you'll see that we started out with $100, the date, start of the $100, and then we record what we use the money for. So we're looking at those petty cash slips. So we wrote 2 petty cash slips, one for miscellaneous expense for $20, one for advertising expense for $14. Total those up, and we have $34. So we need to replenish that. We need to fill our account back up with that $34. We should have $66 on hand. So at the end of the month, we go through and we count up how much we have on hand, and in our petty cash money bag or money box, we actually had 65. So we were $1 short of what we should have had. We should have had 66. 100 minus 34 is 66. We actually only had 65 in there. Sometimes that's just a rounding error. Maybe it was some spare change on one of those petty cash slips and we just rounded. So we are $1 short. Not the end of the world, but we need to be sure that we replenish our petty cash fund for that $1 as well. So our amount to replenish would include that $1 plus the $34 that we had for those 2 petty cash slips. So replenishing petty cash means putting more cash from the cash account into the petty cash account and then recording the payments that have occurred. So that's the bullet point underneath your petty cash report on your note guide. Petty cash is always replenished monthly to ensure that all expenses are recorded the month that they occurred. So even though we had $66 still left to spend in that petty cash bag, we still need to do this monthly because we want to make sure that miscellaneous expense and advertising expense are recorded in the month that they occur. That's one of our GAAP rules. And remember that a petty cash report is proof. So this petty cash report is our proof of what we use the funds on. The last bullet point underneath our petty cash report on the note guide says the amount of the total of all petty cash slips and the amount of actual cash on hand may vary. That's that $1 that we were cash short. But this can cause more or less money to be in the box than what the petty cash slips and petty cash report show should be left. But again, it's not the end of the world. We just need to make sure that we record it and replenish the petty cash fund accordingly. So when we are cash short, that is when, in our last situation, we should have had $66 in our petty cash fund, and we only had $65. So we were $1 short. That could have been the other way around. We were supposed to have 66, but maybe we had 67. That would be cash over. So that's the whole reason that we prepare a petty cash report. So we know exactly how much we need to replenish in that petty cash report. So we have a new account, cash short and over. It's a new account. We debit it when cash is short, just like we would debit any expense. We are $1 short. That's $1 that was lost, $1 that was an expense to the company. We always debit our expenses, so that should make sense. If we are cash over, you could think of that like sales. We earned $1 one way or another, whether it was a rounding error or whatever. We credit cash short and over just as we would credit sales. So the account balance is typically a debit because we're typically cash short just due to change, maybe telling someone to just keep the change on a purchase, whatever it may be. But it's more likely to be short than it is over. So typically we're going to debit cash short and over, but it's possible that you'd be cash over and you'd need to credit. So think of cash short and over. It is an account that has a normal debit balance and it is an expense. So here is that transaction. Again, we are not using the account petty cash. Again, when we do a transaction to replenish petty cash, the only accounts that we are using are the accounts that we use petty cash on. So in this example, miscellaneous expense and advertising expense, and then that cash short and over account. So we're debiting those 3 things. All 3 of them were expenses. And we're crediting cash for that amount. We have our date, going to be the last date of the month. And then we are using those accounts, miscellaneous expense, advertising expense, using the amounts that we spent on those 2 accounts. That $1 that we are cash short, that's also an expense. So this is a 3-line entry. It could be a 10-line entry. If we had 10 different petty cash slips that we use that petty cash fund 10 different times. It could be a 1-line entry. Depending on how many times you use petty cash that month will vary. So in this example, we used it twice, miscellaneous and advertising, and then we were $1 short. The total, 20 plus 14 plus 1, that is how much we want to write the check for. So we're going to write a check for $35. We're going to cash that check, put that cash back into our petty cash fund with check number 11. So we always start the next month. We'll start February 1st with $100 in our petty cash fund. So why do businesses use petty cash funds? Answer this question, answer question number 2. Pause the video and then check your answers before you move on to the work together.